Have you ever wondered how banks make money? You give your hard-earned cash to save, but what do they do with it? Today, I'll explore the fascinating world of finance so you can learn how banks use your saved-up money to make profits.
What the hell do we know about banking?
Banks take deposits and make loans, mostly on property. Owning a bank is like owning the other side of the real estate.
You see, banks are regarded as an essential part of our economy, providing services that help us save and manage our money. But have you ever wondered how they make money? Well, today we're going to be finding that out. So let's dive right into the video. Let me break how the bank uses our money to make huge profits running into the billions every year. Picture this, guys. You just got your first job and you're looking for a safe place to save your money. You go to the bank and open a savings account. You then decide you're just going to deposit your hard-earned cash of $1,000 into your newly opened account and make plans to save up for a trip to Disneyland. Your bank takes your money and combines it with other people's savings. This pooled up money is called a deposit base. The bank then uses your deposit base to lend money to other people, such as home buyers or small business owners. Okay guys, this is where it gets interesting. When the bank takes our saved up money, they just don't willfully loan out our saved up money for free. Spoiler alert, they actually charge interest on the money loaned out to you and I.
This is Ethan, Federal Reserve.
Hey, Heath, Bill here, First National.
Hi there, Bill. How are you?
Good, good. We're running a little low on money.
No problem. How much you need?
Oh, how does 20 million sound? What?
Excellent. We'll ship it over first thing tomorrow.
Wait, he can just call up the Fed and ask for more money and they give him whatever they want? No, pal. The Fed don't give the banks money. The Fed loans the banks money. The banks have to pay it back with interest.
Check this out. Let's say a customer named Jack wants to buy a new car but doesn't have enough money to pay for it upfront. Jack then goes to the bank and asks for a loan of $10,000. The bank approves Jack's loan and gives him the money he needs. However, the bank charges Jack an interest on the loan, let's say 5%. This means that Jack will have to pay the bank back the $10,000 he borrowed plus an additional $500 in interest over the course of a year, or the term period of the loan. In all this, the bank makes a profit by charging interest on loans like Jack's. But wait, what if Jack doesn't pay back the bank? This is where the bank already devised a clever way to ensure that they get their money back. Check this out, guys. The bank carefully screens loan applicants in order to assess their ability to repay the loan. They also ask for collateral, and such as in the case of Jake, it might be his car as a security for the loan. Now, if Jake doesn't pay back the loan, the bank can take possession of the car and sell it to recover their money. That's how they make their money back. By the way guys, if you're enjoying this video so far, I'd love it if you can give me a thumbs up, as it helps the YouTube algorithm share my video to more people just like yourselves. Alright, now let's move on to the next topic where I share more insights on how banks make money. Okay guys, let's do a quick recap. You see, the bank has now encouraged us to deposit our money with them for safekeeping, with a promise to give us a measly interest on the money we've saved in the bank. But wait a minute, we've now found out that the bank doesn't just keep our money, they go ahead to lend our money to other people, and in doing so, every person or company who borrows money from the bank pays an interest on the loan.
How about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10, I owe you 10.
Thanks. Hey, Mo, you owe me 20. Well, here's 10, I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you. Here's the 10 I owe you.
Good, now we're all even.
But there's also another way banks make money, and it's no other than fees.
Stressful. It might make you want to pull out your own hair.
I hate bank fees. I'm sure everyone has been charged a fee for using an ATM that doesn't belong to your bank, right? Well, that's because the bank that owns the ATM charges your bank a fee for using their ATM machine. Your bank then passes that fee on to you. That's not all, guys. You see, banks also charge fees for services such as overdraft protection or late payments. And these fees can add up and generate significant profits for the bank. Another way banks make money is through investments.
From my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
Banks can invest the money from their deposit base in various financial products such as stocks or bonds, as well as commercial real estate. If these investments do well, the bank can make a profit. However, there's still a risk of losing money if the investments don't perform well. Case in point, Silicon Valley Bank.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
Hey!
Hello, Mrs. Sparnickel. How are you today? Making a deposit, are we? Great. We can just put that into your retirement account and make it go to work for you, and it's gone.
What?
Sorry, yeah, that's gone. Please step aside for people who actually have money with the bank. Next, please. You can watch the video I made about the collapse of SVP Bank right after this video by clicking on the link over here. Now let's talk about how banks keep your money safe. Banks are required to keep a certain amount of money on hand to cover withdrawals by their customers. This is called the reserve requirement. The reserve requirement is set by the central bank of the country, such as the Federal Reserve in the United States. Banks also use a process called fractional reserve banking. This means that they only keep a portion of their deposit base on hand and lend out the rest. For example, let's say Sarah deposits $1,000 in the bank. If the reserve requirement is 10%, as it is with most banks, by law, they'll only be required to keep $100 of Sarah's $1,000 deposit on hand and can lend out the remaining $900. This system works as long as not all the customers withdraw their money at the same time. If that does happen, just like in the case of SVP Bank, then you have what the professionals call the run on the bank.
Something wrong. The bank won't give someone their money. Well, I'm going to get mine. Come along, young man. Every penny is yours. And mine too. And get me mine too.
Basically, if there's a run on the bank and too many customers want to withdraw their money, the bank may not have enough cash on hand to cover all the withdrawals. Case in point, the Silicon Valley Bank. And this was what happened during the Great Depression in the 1930s. This is why the governments in major advanced countries have created deposit insurance programs to protect the citizens from the crash of the banking system. These programs ensure that if a bank fails, customers will be reimbursed up to a certain amount. In the United States, the Federal Deposit Insurance Corporation, also known as the FDIC, provides a deposit insurance for up to $250,000 per insured bank, and every G7 country have also ensured that they have some form of government-secured deposit insurance to protect the public in case the bank fails or collapses. So what does all this mean for you and I as a customer of the bank? First, it's essential that we understand the risks and benefits of depositing our money in the bank. While your money is generally safe in the bank, there's always a risk that the bank could fail or make bad investments leading to losses. It's also important to compare different banks and their fees and the interest rates they offer for you saving your money with them in the bank. Different banks offer different rates of interest on savings accounts and loans, and it's crucial to shop around to find the best deal for your needs. Finally, it's essential that you manage your finances carefully and avoid taking on too much debt. While loans can be helpful, taking up too much debt can lead to financial difficulties, making it challenging to pay back what you owe. There you have it, guys. This is how the bank makes money. But make no mistake, banks play a critical role in our economy, helping us save and manage our money. While banks make money by charging interest on loans, fees for services, and investing, they also face risks from loan defaults and bad investments. So, as a customer, it's important to understand the risks and benefits of using a bank and manage your finances carefully to avoid debt and financial difficulties. I hope you found this video informative and has helped you better understand how banks work. If you have any questions or comments, please leave them below. Alright guys, make sure to smash the like button and don't forget to subscribe to my channel, and while you're at it, kindly share this video. Also, click the notification bell to get notified each time I upload a new video. Until next time guys, always stay money smart. Thanks for watching. I'll see you guys in the next video. Bye.